Hi everyone, welcome to the online class Kilora. I'm Lavanya. I'll be your online class trainer for accounting. So today we are going to learn about accounts where numbers comes into the life and tell a story of company financial health. So let's start with the introduction of accounting. The first one is meaning of accounts. According to the finance and business, accounts often refers to the financial accounts. These are records of financial transaction for an individual, business or organization. Here, in a simple term, accounts refers to the financial record that tracks the transaction and the balance of the company. So, it includes things like income, expenses, assets, liabilities, and equity, and the financial accounts are essential for tracking and managing the financial health of the organization. Let's know the definition. Accountancy refers to the practice and profession of maintaining the financial record and also helps in preparing the statement and ensure that they are following the relevant law and regulation. So it involves things like recording, analyzing, interpreting, and communicating. Here, they record all the money transaction in journal and classify all the business transaction in ledger and summarize in trial balance and analyze the financial position of the business and also communicate the financial information with economic entities such as business, government agencies and non-profit organization. Let's know the importance of accounting. The first one is financial reporting. Here, accounting provides financial information through reports like balance sheet, income statement, and cash flow statement. This report helps the stakeholder such as manager, investor, and creditors make a better decision and also manage the resources efficiently. In overall, it helps in maintaining the clear picture of company financial position. The second one is business performance evaluation. Here, the manager use accounting information to evaluate the company performance, set goal, and make strategy decision. So, it helps in assessing profitability, identifying the cost saving opportunities, and also improve area of im- identify the area of improvement and also set goal for the growth. The next one is investor confidence. Here, being accurate and transparent financial statement can build the investor confidence and trust so they can access the company performance and make informed investment decision. The next one is compliance and legal requirements. Here, the accounting ensures that financial reporting and record keeping should be transparent and reliable in financial information. So, it helps us in preventing fraud, mismanagement, and unethical practices. And also, it can avoid legal issues and regulatory fines, and we can maintain the trust of the stakeholder. The next and final one is tax complaint. Here, tax planning is very important and it plays a very crucial role. Here, we have to follow and fulfill the obligations set by the tax law and regulation. So, by preparing the proper accounting, it helps us maintaining the integrity of the tax system and also involves accurating reporting income, calculate and pay the correct amount of tax, and submit all the required tax form documents within a specific deadlines. And also, it prevents us from avoiding penalty and minimizing law liabilities. And next one is types of accounting. There are six types of accounting. One is financial accounting, managerial accounting, cost accounting, tax accounting, forensic accounting, and the last and final one is non-profit accounting. Let's go one by one. The first one is financial accounting. You know very well about the financial accounting. So, The financial accounting means the financial transactions and events are identified and recorded and then classified and then summarized and then easily analyzed and interpreted in the financial statement. So, the main intention is to find out the financial status of the organization, whether it incurs profit or loss in the balance sheet and profit and loss account, and also in the trial balance. Then let's see the example. A company records all its financial transactions such as sales, expenses and investment. They use accounting principle to prepare the financial statement like the income statement and balance sheet. This helps them to track the financial performance and make informed business decision. So let's go to the next one. The second one is managerial accounting. Managerial accounting is nothing but it tracks the incomes, expenses, and assets and liabilities to provide accurate decision making and also financial reporting. Here, the managerial accountants gather together and analyze the data related to the cost and budget so they can provide insight information and helps in increasing the profitability and increases the efficiency and strategy of planning. For example, imagine a company wants to analyze the cost and profitability of its different product lines. So, they use management accounting techniques to gather data on product cost, expenses, and sales revenue for each product. By comparing this information, they can identify which product is more profitable and make strategy decision to optimize their operation and improves the efficiency in decision making and maximum profit. The next one is cost accounting. It is one of the type of accounting and it is one of the branch of accounting. So this type of accounting deals with the transaction which is related to cost. Let's say you have a own bakery. Cost accounting would involve tracking and analyzing the cost associated with producing your baked goods, such as ingredients, labor, and overhead expenses. This helps you determine the cost per unit of each product and make informed pricing decision. And it also helps you identify the area where you can reduce cost and improve profitability. The next one is tax accounting. Here, the tax accounting is one of the specified field of accounting that focus on preparing, analyzing and reporting of tax related information. Here, it involves understanding and applying tax law and regulation to ensure accurate and compliant tax reporting. Here, the tax accounting is essential for ensuring compliance with the tax law and optimizing tax efficiency. Here, the tax accountants assist individual and business in managing the tax obligation and they maximize their tax deduction and minimize the tax liability. They minimize the tax liability and maximize the tax deduction. For example, let's say you are a self employed freelancer. As a tax accountant, you would prepare a annual tax return. So, we'll gather all the information, financial information such as income, expenses, and analyze it to ensure the accurate reporting. So, we'll identify any tax deduction in it. So, by properly applying the tax law and regulation, it helps you minimize your tax liability and ensure compliance with tax requirements. The next one is forensic accounting. It is a specified field of accounting that combines accounting, auditing, and investigating skills to uncover financial fraud. misconduct, or other financial irregularities. Here, the forensic accountants are trained and analyzed financial records, identified and provide expert opinion in legal proceedings. So, their work involves gathering evidence, conducting financial analysis, and prepare reports. They can be used in legal proceedings or internal investigations. I think no need the example for this. So the last and final one is non-profit accounting. Here, it is a specified field of accounting that focus on financial management and reporting of non-profit organization. Here, such as charity, foundations, and education institutions, the main mission is to serve the public interest. They have a unique accounting requirement due to their tax exempted status. So, the non-profit accountants ensure compliance with regulations and provide accurate financial information to the stakeholders and donors. The next is principles of accounting. Here, the principles of accounting often refers to the general accepted accounting principle. It provides a framework for recording, analyzing, interpreting the financial transaction. These principles ensure consistency, accuracy, and transparency in financial reporting. While specifying this accounting standard may varies by countries, the core principle remains relatively consistent. There are some fundamental principles of accounting. They are: first one is business entity principle. It is also known as entity concept. It is a fundamental accounting principle that states that business is treated as a separate and distinct entity from its owner or stakeholder. According to this principle, the financial transaction and activities of the business must be recorded and reported separately from the personal finance of its owner. This means the business assets, liabilities, and revenues and expenses are recorded and reported on its own financial statement in balance sheet, income statement, and cash flow statement. It ensures that financial position and performance of the business. The next one is ongoing principle. This states that business is assumed to continue its operation in identify definitely unless they evidence that business is going to continue. This principle assumes that business will be able to meet its obligation, continue generating revenue, and operates in the future. While preparing the financial statement, the ongoing principle requires that assets and liabilities are recorded on the assumption that the business will continue the operation. So, it allows the proper evaluation of assets and liability and provides the financial statement with relevant and reliable information for the shareholders. And the next one is monetary unit principle. Here, it is also known as unit of measure principle. It is an accounting principle that states that financial transactions should be recorded and reported in a common monetary unit. This principle assumes that the value of money is stable over time. According, it allows the meaningful comparison and analyzes the financial information. Here, transactions are recorded in the single currency, such as US dollar or euro, regardless of the currency in which the transaction actually occurred. The monetary unit principle helps ensure consistency and compatibility in financial reporting. The next one is cost principle. It is also called as historical cost principle. Accounting principle that states that assets should be recorded and reported on the financial statement at their original cost. According to this principle, the initial cost of the asset is considered to be most reliable and objective measure of its value. These assets are not generally revalued to reflect changes in the market value or inflation. The next one is matching principle. It is also known as expensive recognition principle. This principle that states that expenses should be recognized and matched with the revenue they help generating in the same accounting period. It ensures that financial statements accurately reflect the cause and effect relationship between revenue and expenses. The next one is revenue recognition principle. Here, this accounting principle that determines when and how revenue should be recognized or recorded in the financial statement. According to this principle, revenue should be recognized when it is both realized and realizable and earned. Revenue is considered realized when goods and services are exchanged for cash or other asset. Revenue is considered realizable when there are reasonable expectation of receiving payment. The next one is conservatism. This accounting principle suggests that when faced with uncertainty, a company should consider the side of auction and recognize the potential losses or expenses rather than potential gain. Here, the principle encourages the accountants to exercise their auction and avoid outstating the assets or income. This helps ensuring the financial statement are more conservative and reliable by reflecting a more caution and realistic review of company financial position and the performance. The next one is consistency principle. This states that once the company chooses the accounting method or a policy, it should continue to use this method consistently in future periods unless a change in justified and properly disclosed. This helps in maintaining the integrity, reliability of financial statement so the stakeholders can make a better decision consistently and reliable information. The next one is materiality principle. Here it states that financial information should be disclosed if it is material or important enough to influence the decision making of information for the financial statement. In another word, we can say it as information should be material if it is misstatement could potentially impact the economic decision of users. So, we have to apply the materiality principle. Financial statements should provide users with a clear information so they can relevant to their decision making process. It ensures the financial reporting in focusing on the important and impactful information while still maintaining the transparency and accuracy. The next one is full disclosure principle. Here, this accounting principle that requires companies to provide all relevant and necessary information in the financial statement and that ensures that the users of the financial statement has to access the complete and transparent information so they can make a better decision, and also it's transparent information about the company financial position ensures to avoid some risk and uncertainty. The next one is objective principle. Here, It emphasizes the importance of presenting the financial information in an unbiased and objective manner. According to this principle, the financial statement should be based on verified and reliable evidence rather than personal opinions or biased. So, this ensures that the financial statement becomes more credible and trustworthy. So, it helps in ensuring the financial information is free from personal bias or manipulations. Avoid users to make information decision based on objective data. It is very important and it plays a very crucial role in integrity and reliable of financial reporting. The next topic is accounting standards and regulation. Here, these accounting standards and regulations are guidelines and rules established by the regulatory bodies to ensure the consistency, transparency, and comparability in financial reporting. It provides the overall framework of organization to prepare the financial statement and make the investor creditors easily understand the financial health of the business. Here are some of the prominent accounting standards and regulations. The first one is International Financial Reporting Standards IFRS. It was developed by International Accounting Standard Board. Here, it is a set of global accounting standard widely adopted by many countries and organizations around the world. The main goal is to provide a common language of financial reporting and make it easy to compare the financial statement across different countries. The second one is GAAP. As I told you, it's General Accepting Accounting Principle. It is one of the accounting principle. It was used in US, and this Financial Accounting Standard Board is the organization responsible for developing and adapting GAAP. The main aim is to ensure the consistency and transparency in financial reporting for US business. The next one is International Public Sector Accounting Standard. It is a accounting standard developed for the public sector entity such as government agents and non-profit organization. The main important thing is to they improve the quality and transparency of financial reporting in the public sector. The next one is Sarbanes-Oxley Act. It was enacted in US in 2002 and was response to corporate accounting. It was introduced to reform the enhance corporate or governance and financial reporting. It requires internal control and audit committees and the independence of external audits. The next one is European Union directives. It states that the incorporation into the national level. The member states must incorporate into the national level, and these directives may include accounting and financial reporting requirements for company operating within European Union. The next one is IFRS for small and medium size entity. It is a simplified version for full IFRS standards, that is, International Financial Reporting Standards. They mainly need small and medium sized business for financial reporting, so they recognize the needs of smaller entities. The next one is General Accepted Government Auditing Standards. It is issued by US Government Accountability Officer. It provides the standards for auditors for government organization, programs, activities, and functions. It ensures the transparency and accountability and the effective use of public resources. The next one is Revenue Recognition Standard. Both the Financial Standard Board and the International Accounting Standard Board develops this standard revenue recognition. It provides a common framework of recognizing the revenue from contract with customers. The next one is International Standards on Auditing. It is issued by the International Auditing and Assurance Standard Board. It provides a guidelines for auditing, conducting audits for financial statement. These standards help ensure the quality, consistency, and objective for audit procedures.